All right, so good evening, everyone. Um, this evening, we're going to be going into what we call trading terminologies. Okay, this is one of those beginner classes that are very, very, very key because in every business, in every industry, there are the terminologies that are very relevant for every industry, for every business, right? If you're in real estate, you talk about land titles, you talk about the CFO and a whole lot of other terminologies. If you're in supply chain, there are terminologies for supply chain. But if you're in financial trading, there are terminologies specifically for financial trading, and that's what we're going to be delving into today. So it's important we understand them because it tells us exactly what we are doing. It helps us understand what we're doing in the market, how we are capitalizing on, the opportunities of the market, how to navigate our way, basically. These terminologies help us navigate our way through the financial market and, being very clear with what we're doing. First thing is we're going to try to understand the currency pair, right? In a previous session, we talked about how that currencies are traded in pairs. Currencies are traded in pairs. And so what we're talking about here now is we want to more like dissect the currency pair and try to understand it. How do we, understand this pair and what do we do with it, right? So let's look at this. Now you see, this is a currency pair called the Euro USD. This is a currency pair called the Euro USD. The first currency here, the currency on the left-hand side is what we call the base currency in the pair, while the one on the right is what we call the quote currency, the one on the right, all right? So this is very important. This quote currency is also known as counter currency. So why is the euro, in this case, why is the first currency, the currency on the left, why is it called the base currency? So it's called the base currency because it's usually the basis of the trade, the basis of the trade. And by the trade here, I mean buy or sell. This is usually the basis of the trade, right? Now, when you're thinking of entering a trade, be it for a buy or for a sell, this is what you consider. You look at the base currency. Is the base currency about to be strong? Is a base currency about to rise? Is a base currency about to drop? Is a base currency about to be strong or is about to be weak? That's what you're considering. So if the base currency, if you analyze the market and you think that the base currency is about to gain strength, what you do is you make a buy, gain strength against the quote currency, right? If the base currency is going to gain strength against the quote currency, that is where you need to buy. The base currency is about to weaken against the quote currency, that's when you want to sell, right? Now, these currency pairs, these currencies within the pair, these currencies in the pair have a tug of war kind of relationship. They have a scale kind of relationship. So when the base currency is heavy, which means it is strong, the quote currency is usually, if it's strong relative to the quote currency, then you see the price rises. If the base currency is strong relative to the quote currency, you see the price rises. If the base currency is weak relative to the quote currency, you see the price falling, right? This is so important. So this is why we say that you consider the base currency whenever you're getting into a trade. You're looking at the base currency. What is it that's happening with the base currency? Is the base currency about to be stronger than the quote currency? Or is the base currency about to be weaker than the quote currency? That's what you're looking at to determine which direction you should be going. Okay. So let's look at this. This is what we call a currency quote. Okay. You have a base currency, you have a quote currency, and you have a price. You have a base currency, you have a quote currency, and you have a price. Now, every currency pair has a price at this current moment. And that constantly changes, constantly fluctuating. But that currency has a price. The currency has a price at this moment, even though it's constantly fluctuating. Okay, constantly fluctuating, but it has a price. So now the question then is, what is the price? Now, for this currency quotes we're seeing here, we're seeing GBP USD, and we have a price of 1.212228. That's the currency, that's the price that we're seeing here now currently, right? So it means that you have a currency quote, that currency has a base, it has a quote, then it has a price. So this is what you see all the time. But like I said, the price is constantly changing because market is constantly moving. So that is for that. Then we have what we call pips and points. Pips and points. Now, to understand pips and points, think about how you measure distance from one part of a room to another. Let's say you're in a room right now, like just like I'm in a room. You're looking to measure either the length or the breadth of the room. Most of the time, you're going to measure it with respect to meters and centimeters. Meters and centimeters, right? And we know that meters and centimeters are basically the same in the sense that they are used to measure distance or length, right? They're using to measure distance or length, but then one is convertible to the other because one is just a fraction of the other or a multiple of the other, right? Meters is a multiple of centimeters, and centimeters is a fraction of meters. So that is exactly how pips and points work in the financial market, right? So pips is an acronym for price interest points or percentage in points. Pips is an acronym for price interest points or percentage in points. It's a unit for measurement to express a change in price from between two currencies, right? So when price moves from point A to point B, that difference is captured in pips. That difference is captured in pips. So when you look at the price, when you look at two currency pairs like this, you have Euro USD here and other non-JPY pairs, they will usually have 5 digits after the decimal. 5 digits after the decimal place. They usually have 5 digits after the decimal place. So the last digit, when you're looking to calculate pips, the last digit is what we call a pipette, right? In previous times, several years ago, this pipette was an ignored digit. Usually it's a digit that wouldn't even appear in the price quote at all, right? But now it does, it appears. So that is the pipette. Usually when you're on your MetaTrader app, you will see it as a highlighted number. You see it as a highlighted number. It's jumping, it's always changing every so often. It's changing, especially when price is moving very fast, it changes very quickly, right? The next one is what we call a pip. That's 1 pip. 1 pip. Then this is second pip. The second number here is 20 pips. So when you look at it, you are dealing with pipette, you're dealing with pips, you're dealing with multiple pips. You have pipette, the last digits represent pipette. The first digit here after the last one, the second digit after the last one basically represents a pip. If you have 2 here, that means you have 2 pips. You have three here, that means you have 3 pips. Okay, if you have 5 here, it means you have 5 pips. Okay, then the third digit here represents multiple pips. That's more than 10 pips. More than 10, right? Now, to make this easy for you, most of the time you can just take your number. Let's say you're looking for what's the pip number here. When you ignore this last digit here, this just gives you 21 pips. So you see 20 plus 1, this gives you 21 pips. When you remove, not ignore, sorry, when you remove the last digit here, you get 21 pips. But if you want the last digit to be there, it's more like you're adding, right? This was something some of us did in maths some years ago, right? So you have 0.5 pips, you have 1, then you have 20. So when you look at it, this is 20.5. This is actually 20.5 pips right now, okay? Then for USD JPY, one unique thing about JPY pairs is that they usually have 3 digits after the decimal. 3 digits after the decimal. By that, we mean USD JPY, CAD JPY, AUD JPY. Any JPY pair usually has 3 digits after the decimal. And it is treated exactly the same way. as you treat non-JPY pairs, right? The last digit is a pipette. The first digit here after the last one is a pip, and then the third one is multiple pips, so 10 pips and above, right? So this is more like if you have this now, you have 215 points. So this is where points come in. So here you have 215 points. This you have 215 points. But what's 215 points? 215 points is 21.5 pips. For you to convert points to pips, you just divide it by 10. For you to convert points to pips, you just divide it by 10, right? That's what I mean when I said centimeters is convertible to meters and meters is convertible to centimeters, right? So pips and pipettes are basically the same. They are the same units for measuring price movement, but then one is convertible to the other by a division or a multiplication by 10, right? So if you're looking at pips now here, you're looking at how many pips do I have here? And you have 215 points. 215 points is 21.5 pips because you're dividing it by 10. And I also tell people that if you want to divide, if you're dividing it by 10, that's great. If you also want to ignore the pipette as well, that's not bad as well. Because in this market, you're trying to make profit and not really win a mathematical competition. Okay, so here. Now, this is the relationship between pips and points right here, right? 10 points equals 1 pip. So if we have 200, if you have 215 points, that is 21.5 pips. So 10 pips equals 10 points equals 1 pip. 100 points equals 10 pips. So you see that now is a division by 10. You take the point number, you slash it by 10, you divide it by 10, you have your point, your pips. Now, pips is an old word. A lot of traders use pips a lot, and if you come into, it's more like a term that is very well known. Even though it's old, it is still very well known in the industry, and everybody uses it, right? So fewer people use points when it comes to calculating price movement. More people use pips when it comes to calculating price movement. So if you're new to trading, you want to understand both of them, right? And decide whichever one you want to use. But basically, you are doing this to make profit, not trying to be very, very, very. It's not an academic session. It's not an academic. It's not for academic purposes. All right. So this is the relationship between pips and points. So another terminology is what we call the spread. The spread. All right. Now, spread is quite interesting because the spread is the charge, is what you pay whenever you get into a trade. The spread is what you pay whenever you get into a trade. All right. So it's something to watch for. And Advantage Markets, we pride ourselves as one of the best brokers with the lowest spread you can get. With the lowest spread you can get, and that's very, very important because the larger your spread, the more money you are paying out. The larger your spread, the more funds you're paying out, right? So, and that's why we want to make sure that we serve you better, serve you well by giving you very tight spreads, across our instruments. So, when you pick your phone right now, you go to MetaTrader 5, you will see that every currency pair has two prices. Every currency pair has two prices. Something you could do as well is tap on the currency pair, let's say Euro USD, tap on it, then go to new order. You will see that on the left-hand side, you have a sell price. The right-hand side, you have a buy price. Left-hand side, sell price, but right-hand side, buy price. The difference is what we call the spread. The difference is what we call the spread. Now, you notice that if you place a sell trade and a buy trade immediately, they will not trigger in the same place. But they're supposed to trigger, and you would think that they're meant to trigger in the same place. But they're not, they won't trigger in the same place because there is a spread in between them. The prices between them are not the same, just like you're seeing on the screen here. Bid price is 1.1051. While ask price is 1.1053. So that difference of 2 pips is the spread, right? So that is how brokers make money. That's the reason why if you fund your account, you're not trading, a broker may not make money because you can easily come and make a withdrawal and collect your money, right? So it's important that you're trading. And the thing is that this trading on the platform is beneficial both ways. While it's good for you to make profit, we also there's no way you're going to make profit, but if you don't place a trade. And when you place a trade, you're making. Now, another concept is what we call the lot and lot sizes. Lot and lot sizes. Lots and lot sizes. Now, in trading, there is what we call volume. Lot and lot size is also referred to as volume in the market. Now, think about it. When you go to a gas station and you want to buy fuel, go to a fuel station, you want to buy fuel, right? Now, two people, let's say you are going with someone or you met someone there, and then you go in with a huge tank, a huge jerry can, a huge container, like a 50-liter container, right? And another person comes in there with a 20-liter container. You agree with me that the one with a 50-liter container is going to buy more. He has a bigger capacity to take more. And then he's also going to spend more, right? So when about, filling his container for him, they're going to ask him, do you want it full or do you want it half? Or you want it to fill up to a level, you want it to fill up totally? So that's what they are asking you basically is, what volume of fuel do you want? What volume do you want? That's what they're asking for. So that's what it is also in trading. If you are buying and selling gold, if you are buying and selling Euro USD, the question is, what is the volume of your trade? What exactly is the volume of your trade? How much Euro USD are you buying? How much gold are you buying? How much Euro USD are you buying? How much gold are you buying? That is what is represented by volume. Okay, so think about it, and it's a correlation. It's directly correlated. It's directly correlated to the account size you have. It's directly correlated to the account size you have. So you don't just randomly pick your lot sizes. You also look at it with respect to how much do I have in my account that can carry this trade, and how much am I risking of that fund. Okay, so there are three categories of lot sizes right here. Three categories of lot sizes. The first one is what we call the standard lot. The standard lot. The second one is what we call the mini lot. The third one is called the micro lot. Now look at this. The standard lot is usually referred to as having 100 nominal value. 100,000 nominal value, right? 100,000 nominal value. It's more like $100,000. It could be 100,000 euros, depending on what currency you're trading. It could be 100,000 Swiss francs, depending on the currency pairs, the currency pair you're trading, right? Very important. Okay. Now, standard lot ranges from 1.0 to all the way to 100 lots. 1.0 to all the way to 100 lots. That is the standard lot, right? So if you're about to take a trade and you select 1.0, you are selecting the standard lot. If you're about to enter a trade and you select 100.0, you're entering 100.0, you're entering the standard lot as well. Okay. So that's for standard lot. Starts from 0 all the way to 100. A mini lot has 10,000 units of currency. 10,000 units of base currency. That's why we say base currency. That's why I said it depends on the currency you're trading. So if you are trading a USD JPY, for example, you know that it's 100,000 units in dollars. If you're trading Euro USD, for example, you know it's 100,000 in euros. If you're trading GBP USD, then you know that we're talking about 100,000 in pounds, okay, in GBP. So a mini lot is $10,000 in nominal volume of base currency. But this is represented by picking numbers from 0.1 all the way to 0.99. That's the mini volume, mini lot. So mini volume, mini lots, basically the same thing. Okay. The micro lot is the last one, the smallest. Micro lot represents 1,000 units of nominal, 1,000 units of base currency, which is 1,000 nominal volume. So this is the smallest. When you start with 0.01 all the way to 0.09, you are dealing with a micro lot. And like I said, what determines the lot size you're picking is the volume, is the size of account you have. If you have $200 in your account and you want to trade gold, you won't be picking 0.1 or 0. Or 1.0. That would be really bad and that would be really disastrous. All right? That'd be really disastrous. So you don't want to do that because you know that that would be very bad for your account. If that would be very bad for your account, then you don't need to do it. Okay? So that's what you determine based on what you have, because your account balance is basically your capacity. You can't put a load that is bigger than your capacity on your account. It destroys it. It can destroy it. All right? So yeah. Now this is what I said before. Micro accounts have 1,000 units of currency, i.e. USD. It could be USD, it could be whatever is the base currency is what we're dealing with here. 100. This represents 1,000 units of currency. Could be dollars, it could be pounds, it could be euros, depending on what the base currency is. We just talked about base currency. Depending on what the base currency is, right? So micro loss starts from 0.01. Mini loss starts from 0.1. This is more like a summary of what we just said. Standard loss starts from 1.0 all the way to 100. Okay. Now, if you take a trade in Euro USD and you are using a micro lot. Micro lot is 0.01. Remember that, micro lot. And you're taking 10 pips, that will give you $1. Which means 1 pip will give you 10 cents, right? Now, if you take the same trade, right? You take the same trade, you catch the same 10 pips, but you are using a mini lot. Mini lot is 0.1. It gives you $10. You take the same trade, right? The same Euro USD trade, nothing has changed. You take the same Euro USD trade, you take 10 pips, and you use a standard lot. Sorry, this is 10 pips. Use a standard lot, and you get $100. The same currency, the same trade, the same pips value that you're catching, but the only difference is the lot size. So micro lot, mini lot, standard lot gives you something totally different, very far apart. So this is so important. Now look at this. When it comes to entering your trade, placing a trade in the market, you come to your chart and you go to new order. See new order there. Go to new order. This is you doing your trading from your computer, from your laptop. You go to new order, you click on new order. Then once you click on new order, what happens is that a pop-up, a box pops up. Once it has popped up, you can see the currency you want to trade is already there. On that symbol, already there. Now remember, watch this. When you want to trade and you are on the currency, what happens is that the chart automatically assumes that you want to trade on the current currency. It automatically assumes that you're trying to trade on the current currency. So when you click on new order, you will see that the current currency is going to be there as default. It's going to just appear there because it's assuming that you want to trade on the current currency. So if that's not what you want to trade on, you change the chart, or you see the drop down arrow beside inside symbol. That drop down, there's a drop down arrow there. The drop down here. There's a drop down arrow here, right? So this arrow is what you click on. Once you click on that arrow, you can then change to another currency. If Euro USD, for example, is not what you want to trade. If Euro USD is not what you want to trade, you can use this drop down arrow here to change to whatever you want to trade. All right. So the next one is volume. So you see, I said lot size, lots and lot size is synonymous with volume, right? So you can see on MetaTrader here is showing you volume instead of showing you lots, right? So showing you yes lots, right? But then Inside volume appears lots. So the minimum loss, like we said before, is 0.01, which is a micro lot. And then it continues all the way. You notice here, for example, you do not have 0.1 or 0.5. So you realize that inside here, you do not have 0.1 or 0.5 or 1.5 or 1.2, whatever. You don't have any of that. And the reason for that is that you can actually manually impute anything you want to impute. You can manually impute anything you want to impute. So you can decide, okay, this trade I want to take 0.5. You type it in manually and to activate. Okay. So the next thing we're talking about here is what we call margin and leverage. Margin and leverage. So this is quite important because it speaks towards risk. It speaks towards risk and starting to imbibe the consciousness of risk. It speaks towards risk and it has to do with beginning to imbibe the consciousness of risk. The first one is margin. Margin is the amount of capital a broker requires to enter and hold a trade. So let's say you have $500 in your account and you place a Euro USD trade and use a standard lot, 1.0 standard lot for the trade. What happens is that a portion of your $500 is allocated to that trade. As long as that trade is running, a portion of your capital is allocated to that trade. So that trade continues to run until that money closes. So let's say $50 is allocated, or let's say $100. You have $500 in your account. Then $50 is allocated to that. $100 is allocated from that 500. 100 is allocated to the trade you just took now. What that means is that that's what we call margin. What that means is that that money is locked into that trade. That you now have $400 left to take a trade. Now your balance will still be showing 500 because the money was not removed from your account. It's still in your account. Nobody's removing any money from your account, but the monies are still there in your account. Balance is showing 500 and is correct. But now you want to be able to ask yourself, how much is being allocated? So you look at you enter the trade, $100 is being allocated to a trade. Once that $100 is allocated, it means that $400 that's remaining can still be used to enter further trades, but that $100 is no more available to enter new trades. It's no more available to enter new trades until that trade is closed, because that trade, that's $100 is maintaining a trade that is currently in the market, is currently running. So what's important then is what you need to do if you want to enter another trade, you can use the remaining 400 to enter further trades, right? But if you really want to enter a trade with these monies that you have allocated to a running trade, all you need to do is close that trade. Once you close the trade, the funds become available to you to trade with. The funds become available for you to enter another trade with. So that $100 that had been locked in the trade, once the trade closes, the $100 is available again for you to enter another trade. Margin and leverage. Okay, so this is it. What this is, okay, sorry. That is just margin, right? Now, the next thing we're considering here is what we call leverage. This is so important because I know a lot of us have heard about the word leverage. Leverage is how you get rich, or leverage is how you make a lot of money. So what is leverage in the financial markets? Leverage is the allowance a broker gives you to enable you enter and take larger positions than you normally take. So a broker gives you a leverage to allow you to take larger positions than you will normally take, right? You take larger positions than you will normally take. So that's it. Now, it's an allowance. Some people will ask, is it a loan? Is it monies that deposited in your account? No, it's none of that. And it's not even credit bonus. It's not credit bonus. It's different from credit bonus. It's different from credit bonus. This is not a credit bonus. This is an allowance. It's more like a band that is put within your account. So the leverage will help you to take larger positions that your monies would normally not get to, right? So if you increase your leverage, if you have $500 in your account and you're using 1 to 100 leverage, with the trade you're able to take is smaller than the one you would take if you have a trade and you are using a leverage of 500. So we said the relationship between margin and leverage is expressed as a ratio. You have 1 to 500. The 1 is the margin, 500 is the leverage. So on Vantage markets, we have from 100 leverage all the way to 2000 leverage. 100 to all the way to 2000. Okay. So leverage allows you to take larger positions. It means that when it comes to taking lot sizes, if you have a big leverage, you can take larger lot sizes on your account. The same account that will normally not take a certain lot size will begin to take that lot size now because leverage has increased. Yeah, because leverage has increased. So the relationship between margin and leverage is expressed as a ratio. So this is a chart that shows you how leverage helps you to power up your income or power up your trading capital. If you're not using leverage at all, and by the way, there's nobody that's not using leverage, no matter how deep you are, deep pocketed you are, there's nobody that's not using leverage, except you have $100 billion in one account. And even if you do, you still want to be able to leverage it to do more. Okay. So now look at this. You have 1-to-1, which means you're not using any leverage. For you to be able to command $100,000 in capital, you need to have $100,000 of your own. For you to trade as though you have 100,000, you need to have 100,000. Then look at this, 1 to 1,000. For you to trade 100,000 volume, all you need is $100. All you need is $100, right? So the more your leverage, the less capital it takes to basically do big things in the market, right? It's more like you're using your lever to pull up your tire. Let's say your tire got deflated and you want to lift up the vehicle. You want to lift up the vehicle and change the wheel, right? Change the tires. What happens? You use a certain type of lever, right? And when you do it, it becomes so easy. It's easy to do. You just do it, and the thing is going up. But if you think about you having to put your hands under the car and pull it up, that will be way more difficult. Okay. So these are other terminologies right here. Other terminologies. We say when we say go long, it means to buy. When we say go short, it means to sell. When we say bullish, you are bullish, it means we're in a rising market. When we say we are bearish, it means we're in a falling market. When we say take profit, we're talking about the reward on the trade, okay? Because every trade has a risk and a reward. If every trade has a risk and a reward, what is the reward on the trade? On the trade, it's called take profit. Then the stop loss is the risk on that trade. And what does the stop loss do? It helps define your risk and protect your funds. So you define your risk before your trade starts by using a stop loss. And then you protect, and it helps protect your funds as well. Bid is buy price, ask is sell price. Spread is the difference between bid and ask. Swap is an overnight charge that you pay or get paid, depending on what you're trading. So if you're trading gold, for example, or AU/USD or Euro/USD or GBP/USD, there's an amount there's a certain fee overnight. Overnight means you enter a trade today and you hold it all the way to tomorrow. You enter a trade today, you hold it all the way to tomorrow. That is an overnight trade, right? Now, when you have an overnight trade like that, once the day closes and opens, once today closes and tomorrow and the next day opens, what happens is that a swap gets applied to your account. That's that swap is either positive, which means that you get paid swap, or it's a negative to your account to determine whether you are going to be charged or paid is not really something that you need to be so concerned about. What matters is that it will get done by itself, right? It will get applied to your account, and it has to do with interest rates, interest rate differentials, right? So if you're trading Euro USD, for example, Euro has a certain interest rate different from the US economy. The Euro economy has a certain interest rate different from the US economy, right? So that difference in interest rate is what plays into what we call swap, right? And like I said, whether you're buying or selling will determine whether you'll be credited swap or you'll be charged swap. All right. So then next thing is we have margin. Margin is what I just talked about. Margin is the amount of capital, amount out of your capital that a broker requires to enter and hold a trade. Then leverage is the allowance the broker gives you. It's like a band that the broker gives you to enable you take larger positions. So if you decide I want to take 1 to 100, okay, good. If you decide you want to take 1 to 500, it's good. Just know that with leverage, leverage is a two-edged sword. Leverage can help you make a lot of money very quickly. Leverage can help you make a lot of money very quickly, and leverage can also help you lose a lot of money very quickly. So when you see people who are on social media, they're saying, "Oh, I turned 200 to 2,000 in one day," and all that. They're using a large amount of leverage. They're using a large amount of leverage, and that's the reason why they're able to grow accounts so heavily within a short period of time, right? So you want to understand that if you do not understand leverage very well, you don't want to use a lot of it. You can take a lot of it, but you don't have to use a lot of it, right? Because if you use a lot of it, it can have a detrimental effect on your account, make you lose money. Then we have PIPs, which is price interest points. Okay. So the next thing we're going to be going into is trading platforms. On our next class, we're going to go into trading platforms and entering trades. Okay. Thank you very much, guys. Our class will stop here. Do you have any questions? Anybody with any questions?